I expect the metals to be in a more vertical tone, especially evident over the next month, perhaps extending past the election, but a lot of it probably before the election. So I'm thinking over the next 5 weeks, you could see silver do something like go to $55. There's some technical reasons for that. And gold, I think, go to 3,000 to 3,200. Now, which on a percent basis is far less than silver going to 55. And I think silver is about to re-engage again in terms of its relative performance. Right now, it's still dirt cheap versus gold. And there's some technical reasons for us to assume that it could reignite its relative strength in a way that is, sort of jaw-dropping. Okay.
Gold has been on a non-stop tear higher of late, hitting new record highs for 5 straight days to the excitement of longtime gold bulls. Although some analysts are warning the yellow metal may be approaching overbought territory, one portfolio manager says there are lots of upside opportunities in the miners. Proprietor of Momentum Structural Analysis, MichaelOliver, believes that gold and silver are entering a highly dynamic phase. Based on the market fundamentals, he predicts gold surpassing $3,000 and silver hitting $55 driven by momentum, with silver expected to outperform gold before the election. Silver rose to its highest level in nearly 12 years on Thursday, riding the coattails of gold's rally to record peaks as interest rate cuts by major central banks fueled investment interest in precious metals. Additionally, Michael notes that miners, which have underperformed since 2020, are now re-engaging and could see a significant rise, with GDX potentially reaching above $50. The current VanEck Gold Miners ETF, GDX share price is $41.31. The score for GDX is 69, 38% above its historic median score of 50, and it infers a lower risk than normal. Regarding T-bonds, Michael anticipates short-term gains as a safe haven, despite their negative long-term outlook. He expresses that within a few months, more capital may shift into gold as the preferred asset. According to market experts, gold prices often follow U.S. Treasury yields because of the inverse relationship between yields and the yellow metal's opportunity cost. The 1-year U.S. bond yield is higher than the 10-year at 3.98% and the 10-year at 3.77%. Rising short-term Treasury yields can make bonds more attractive than gold. Yet, in a Fed rate cut scenario, gold prices tend to align with Treasury yields, reversing their usual relationship. Now, we present the clips of MichaelOliver's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
That we look at are the monetary metals, also commodities, but they're not always linked. Stock markets, bond markets, and foreign exchange, and they're about to get all very dynamic, is our argument. But gold led the way. It's not a dumb market. It doesn't follow events. Everybody thinks, it follows a data point. But yeah, maybe it responds in some way, but basically it's a smarty. It knows ahead of time what the major trends are going to be. So in late March, gold woke up after 3 years of this doldrum. Silver and the miners had been in a staircasing downside correction where gold basically went sideways, they went down. Okay. But they all woke up at the same time using our metric of annual momentum, meaning we measure the action versus a 36-month average, for example. And it's not crossing the average, it's crossing structures that we see on the momentum charts. Okay, stop that. We'll not confuse anymore. But they broke out and they surged. Gold was just above 2,000, shot up to 2,450, went sideways for a bunch of months. Now it's 26 plus, 2,650. Silver exploded, shot up to 29, just short of 30, backed off. And then in May, while gold went sideways, silver gained more, got up to 3,250 area, which is where we are today. For a third time, by the way. I expect the metals to be in a more vertical tone, especially evident over the next month. Perhaps extending past the election, but a lot of it probably before the election. So I'm thinking over the next 5 weeks, you could see silver do something like go to $55. There's some technical reasons for that. And gold, I think, go to 3,000 to 3,200. Now, which on a percent basis is far less than silver going to 55. And I think silver is about to re-engage again in terms of its relative performance. Right now, it's still dirt cheap versus gold. And there's some technical reasons for us to assume that it could reignite its relative strength in a way that is, sort of jaw-dropping. Okay. And the miners are doing the same thing. After underperforming gold between the 2020 high and 2023, they went down sort of in gold sideways. They've now re-engaged. And GDX, which is up to 41 plus right now, its high back in the mid 2020 rally was 45.75. Okay, so we're still about 10% short. I expect it to blow that out and go up into probably the mid 50s, which is also where I think silver is going to go up in the mid $50 range. In this surge, now, I don't mean to say that's the end of the bull market. I'm just saying in this particular exhale or inhale, however you want to view it, that surge could carry that far for those two particular markets, thereby outpacing gold over the next, let's say, month or two. Then we get a pause. I don't think it's the end of the bull market whatsoever. I think it's just a possible place to pause, but it's way up there. I mean, if we went to $55 silver, people would be astounded, especially if you did it quickly. The very long-term technical trend of the T-bonds is bad. It's negative, okay, meaning higher yields ultimately. It's not a good asset to own from an investment point of view. But from a trading point of view over the next quarter or so, I think it will gather the flow of money again that's moving from the 60-40, moving more back into T-bonds again, as simply a place of safety relative to what is perceived to be potentially unsafe stock market. And it's coattailing some of the buying that's coming in, has come into gold and gold miners, for example. It's outflow from the stock market going into gold, the miners, and to T-bonds. If you go back and look at the 2000 stock market top to the 2002 bear low, or the 2007 stock market top to the 2009 low, two assets rallied during that time, gold and T-bonds. Now, this time around, though, it's a bit different in that I think the T-bond rally is going to be limited. It's going to be fun, for maybe another quarter or so, but you better don't get married to it because the very long-term trend is broken. This is a major counter trend rally. And ultimately, if that market starts to shake as well, at some point, a quarter or two from now, even more money is going to flow into gold.
During the interview, MichaelOliver explains that gold miners are still undervalued compared to gold, even after recent gains. He notes that larger asset managers are shifting into gold and miners as stock market risks rise. He predicts a stronger move into the mining sector, especially in the fourth quarter, leading to significant gains. Notable contrarian investors are paying attention to gold miners. For instance, Stanley Druckenmiller made headlines when he sold off big tech stocks like Alphabet and Amazon in late 2023 and started buying into gold miners like Newmont and Barrick. According to MichaelOliver, junior miners are poised to outperform larger companies eventually. He highlights the sector's small size, making it highly responsive to incoming investments, which could lead to rapid gains as more capital flows in. Let's get back to the interview.
We haven't done much analysis on GDXJ recently versus GDX, for example, but we know a couple things, and these are technical observations. Anybody can see it if you do your own looking at the spread relationships. But the gold miners relative to gold are dirt cheap. Okay.
Yes.
They used to be at much higher relative levels to gold back 10, 20 years ago. And then in that 2015 bear trend, the spread relationship, not only did price go down, but the spread relationship of miners to gold collapsed. Now, since the 2015 low, again, off the page cheap relative to gold. This is true also versus the S&P 500. They've firmed up, but in a way that almost looks like they're hardly off the ground. Because if you look at the spread chart where it was 10, 20 years ago, and then look at it now, and you say, geez, yeah, they've been firming. Actually, we did a report in the weekend report. We showed how GDX actually, if 3 years ago, this is September, 3 years ago, if you bought GDX, you made more money in GDX than you did in the S&P 500. People would drop their jaw at that. It's true. Okay. GDX has also gone up more than gold on a percentage basis, but it's still dirt cheap, historically speaking. It's a tiny little category, miners, the gold and silver miners, on an asset basis. So when big asset managers look around and they perceive risk in the stock market, greater risk than they're comfortable with, they want to therefore move into something that feels better. And they may not even have an intellectual argument for it. They may just say, it's doing better. It feels better. even if I'm not a gold bug. And so you had guys like Druckenmiller back in February went into Newmont Mining, biggest gold miner out there, big blue chip, And if you look at the price chart back then in mid-February, it was $31, $32. Now it's now 55, I think. Okay. So he's done fairly well, right?
Mhm.
He beat the heck out of the market, even the stock market. And it's crossing the various hurdles. We got very bullish at 42. He actually beat us on that. But we had a major breakout in momentum when it crossed 242. Now it's again 55. It's evidence to me that the big blue chips in particular, and it's heavily weighted within GDX, for example. Newmont is the monster. Okay, that big asset managers are getting antsy about the stock market, and frankly, if you go sideways and look at the charts, they really haven't made much money in the last several months.
Mhm.
It's been steady and firm after having broken down, but it's really not going anywhere. It's spinning its wheels, but looking good still. Okay.
Mhm.
But they realize there's a lot of them are skeptical. They have reasons. Maybe it's not reasons that I would have that are macro technical, but fundamental reasons. The valuations are just too high. Risk reward doesn't look good. So they're looking elsewhere. And I think they're buying T-bonds. They're definitely buying gold and gold related. And I think the miners are getting the benefit of that and will continue to. And at some point, the juniors will definitely outpace the biggies. And you're seeing some evidence now with GDXJ versus GDX, where the real cheapies suddenly get electrified. Why? Because they're a small little sector and it doesn't take a lot of money moving from stock market over into the miners to suddenly goose that sector. And I think that's what you're beginning to see. So if we get more wobble in the stock market, and we're expecting a very serious wobble in the fourth quarter, you're going to get more money fleeing that category and going where? Whatever looks good. And right now, frankly, one of the better looking sectors, if you measure it objectively, is the gold miners.
As gold and silver enter a pivotal phase, there's a strong possibility that significant shifts will occur in the mining sector. Wall Street sees gold nearing $3,000 after soaring more than 20% this year. Gold has outperformed the broader U.S. stock market this year, and Wall Street is turning more bullish on the precious metal as the Federal Reserve gets closer to rate cuts. How do you see the evolving landscape of the gold and silver markets impacting your investment strategy in the coming months? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.